To our talk of the tape, whether the bears are suddenly sweating as stocks stay resilient and the VIX drops again. Well, let's ask one. Greg Branch of Veritas Financial Group is back with us today. I don't know. I can't see the picture very well. Are you sweating? Because you are a bear, and this market's been getting away from you, hasn't it?
It has, Scott, but I am sweating no more than I was sweating in August of 2022, and it seems a lot like August of 2022. Shall I count the ways?
Well, I mean, you don't have to go through all of them, but surely you had to have looked at this market and wondered to yourself, am I wrong? In fact, do the bulls now have control based on the way things have been trading, honestly?
Yeah, look, and I think we ask ourselves that question every day, Scott. So the question is there whether the market's going towards my prediction or not. But I think it is important to count the ways. So I'm going to do that. But just like in August, we have kind of this erroneous policy expectation that we've had to fight. Then it was talk of a pivot. Now it was the market looking for interest rate cuts in the back half, which for 6 months I have been incredulous about, as not seeing that as a possibility. We fought the notion that the market was cheap back in August, that it was 17 times. And just as then, the estimates are wrong. So no, the market's not trading at 17 times. The market's likely trading at 20 times forward. And then as now, and we're all built this way, we're all human beings, we all want the market to go up. But when these things are powered by emotion and not the substantive data that we're receiving, it's hard for me to envision this as having any legs as the narrow breadth indicates.
But Greg, your view sounds to me like the one that's potentially being powered by emotion, not by where the market has actually gone, right? You've been negative for some time. The market's been going in the opposite direction.
Right.
The economy's been, I think it's fair to say, more resilient than most have expected it to be. I think earnings have remained more resilient than most have expected them to be. And I think AI is potentially a bigger earnings dryer than almost anyone expected it to be, because we weren't even having this conversation back in August of 2022.
And I concede everything you're saying, Scott. The problem is in the first two things you said. The economy has proven to be more resilient than we thought it would be. Admittedly, we had a stronger than expected first quarter. We're likely to have a stronger than consensus second quarter, but we have to examine why that is. And I think part of that was the Fed spending down $700 billion of untaxed and unborrowed money, which was a shot of adrenaline. And so it doesn't really, that's not what plays into our forecast. What happened, what's going to happen is more important to our forecast. And right now, consensus took the opportunity on an unexpectedly strong first quarter to raise estimates, when likely what we should be doing is looking at that third quarter with 2% growth and 9% in the fourth quarter, and starting to decrease those estimates. And I do believe that we'll see significant downward earnings revisions. I do believe that the Fed have to do one of two things. They either have to raise rates or they have to abandon the search or the quest for 2% inflation. There is no third possibility, and you can't have both.
Yes, there is. There is. There is. That they don't raise in June, which seems like that's the likely scenario. And they don't have to raise nearly as high as you still think they'll go, because inflation actually is coming down faster than you want to admit.